the simplest way to get paid from stocks you already own. What if your stocks could pay you every single month, even when they don't go up? No dividends required, no day trading, no staring at charts all day. There's a strategy that thousands of investors use to collect consistent income from stocks they already own, and most people have never even heard of it. It's called the covered call, and by the end of this video, you're going to know exactly how it works, when to use it, and why it might be the most underrated income strategy in the market today. Welcome to Covered Wings, where we break down option strategies in plain English so you can make smarter decisions with your money. Let's get into it. Here's the reality most investors live in. You buy a stock, you hold it, you wait for it to go up, and while you're waiting, sometimes weeks, sometimes months, that stock just sits there doing nothing. It's not growing, it's not paying you, it's just existing in your account. Now imagine if that same stock could generate income for you every single week or month, regardless of whether it goes up or stays flat. That's the power of the covered call. Think of it like renting out a room in a house you already own. The house is your stock. You still own it. You still benefit if it goes up in value. But in the meantime, you're collecting rent from someone else who wants to use it. That rent, that's your options premium, and it hits your account the moment you make the trade. This is why covered calls are one of the first strategies professional traders and fund managers learn. It turns a passive asset into an active income machine. And here's the thing, you don't need to be a Wall Street genius to use it. So what exactly is a covered call? A covered call is when you own at least 100 shares of a stock, and you sell someone else the right to buy those shares from you at a specific price, called the strike price, by a specific date, called the expiration date. In exchange for giving them that right, they pay you money up front, immediately. That payment is called the premium, and it's yours to keep no matter what happens. Let's use a real example. Say you own 100 shares of a stock trading at $50 per share. You sell a covered call with a strike price of $55 expiring in 30 days. The buyer pays you $1.50 per share for that right. Since one contract covers 100 shares, that's $150, deposited straight into your account today. Now one of three things happens. Scenario 1. The stock stays below $55 at expiration. The contract expires worthless. You keep your $150 and you keep your shares. You do it again next month. Scenario 2. The stock goes up past $55. Your shares get called away at $55. You still made money on the stock appreciation, plus you keep the $150 premium. Total win. Scenario 3. The stock drops. This is the risk. Your $150 premium cushions the loss, but you're still exposed to downside just like any stockholder. That's it. That's the whole strategy. So how do you actually do this? Step 1. You need to own at least 100 shares of a stock. This strategy only works if you already have the shares, which is why it's called a covered call. Your shares cover your obligation. Step 2. Choose your strike price. Most beginners go slightly out of the money, meaning they pick a strike price a little higher than where the stock is currently trading. This gives the stock room to grow while still collecting premium. Step 3. Choose your expiration date. Most income-focused traders sell options that expire in 30 to 45 days. This hits the sweet spot of theta decay, which is just a fancy way of saying the option loses value over time, and that works in your favor as the seller. Step 4. Sell the call. In your brokerage platform, go to the options chain for your stock, find your strike and expiration, and hit sell to open. Confirm the order. The premium lands in your account almost instantly. Step 5. Manage or repeat. If the option expires worthless, you start over next month. If you want to close the trade early, you can buy it back at a lower price and pocket the difference. The platforms that make this easiest for beginners are tastytrade, thinkorswim, and Robinhood for very basic access. tastytrade is specifically built for options traders and is where a lot of serious covered call sellers operate. This is where you separate yourself from basic explainer channels. The when is what beginners don't know. Now here's what most beginner videos don't tell you. The when matters just as much as the how. The best time to sell covered calls is when implied volatility is elevated. Implied volatility, or IV, is basically the market's expectation of how much a stock might move. When IV is high, options premiums are fat. You get paid more for the same trade. When earnings are approaching, when the market is choppy, when there's fear in the air, that's when covered call sellers get paid the best. Conversely, avoid selling covered calls right before a major earnings announcement on a stock you don't want to sell. If the stock rockets on earnings, your shares get called away and you miss the big move. The ideal setup for a covered call looks like this. You own a stock you're neutral to slightly bullish on. Implied volatility is above its historical average. Earnings are at least 30 days away, and you're okay with selling those shares at the strike price if you have to. That's your green light. Now I know what some of you are thinking. What if the stock crashes? Here's the honest truth. A covered call doesn't protect you from a major drop. It reduces your loss by the amount of premium you collected, but if your stock falls 30%, the $150 you collected isn't going to save you. This is why covered calls work best on stocks you actually believe in long term, stocks you'd hold through a dip anyway. The premium is a bonus on top of your conviction, not a safety net on its own. And if you're thinking, I don't have 100 shares of anything expensive, look at lower-priced stocks or ETFs like SoFi, Ford, or even SPY options on a smaller scale. You don't need to be rich to start. The covered call is not a get-rich-quick strategy. It's a get-paid-consistently strategy. If you own stocks and you're not selling covered calls, you're leaving real money on the table every single month. In the next video, we're going to walk through a live example, picking a real stock, choosing the right strike and expiration, and showing you exactly what the trade looks like on the platform. If you want that, hit subscribe so you don't miss it. And drop a comment below. Tell me what stock you're thinking about running a covered call on. I read every single one. See you in the next one.